Are you collecting sales tax in every state where you're required to do so? Getting this wrong can create serious headaches and fines for your business. This is why understanding your sales tax nexus footprint, or the states within which you're legally required to collect, is critical. In this video, we'll help you understand how to determine where you have nexus, how to identify the date each requirement began, and how to build your own clear footprint for sales tax compliance. Step 1 is to identify where you have physical nexus. Physical nexus simply means your business has some kind of presence that ties your operations to that location or state. If you have physical nexus, you don't also need to meet any sales or transaction thresholds. Your physical presence alone is enough to create an obligation to collect sales tax within that state. Here are some common ways a business can establish physical nexus: having an office, store, or warehouse in the state, employing people, whether employees or independent contractors who live or work there, owning or leasing property in the state, storing inventory, even if it's through a third party like Amazon's FBA program. Each of these examples creates a physical link, and once that link exists, the state can require you to collect and remit or submit collected sales tax to the state for sales made to customers within that state. So your first step is to list out every state where you or your team physically operate in any capacity. Those are your physical nexus states. Step 2 is to determine where you have economic nexus, which is based on the sales activity rather than physical presence. Economic nexus was created by the 2018 Supreme Court case of South Dakota versus Wayfair Incorporated. That decision allowed states to require out-of-state sellers to collect sales tax once they reach certain economic thresholds. These thresholds are typically based on either total sales dollars, numbers of transactions, or both, and these amounts can vary from state to state. A common standard is $100,000 in sales or 200 transactions in a year, but not every state uses the same criteria. For example, Florida sets its threshold at $100,000 in annual sales with no transaction count. New York uses $500,000 in sales and 100 transactions as its combined threshold. To see the exact thresholds for every state, we've linked our economic nexus by state chart in the description below. It's a comprehensive reference that shows where each threshold begins and when it became effective. When you review your data, be sure to look at both recent and historical sales. Many states determine economic nexus based on activity in the previous or current calendar year. So even if your sales have slowed, you may still have obligations that started earlier. Step 3 is to combine both types of nexus to build your nexus footprint. This should include each state where you have nexus, the reason nexus exists, for example, employee in state or exceeded $100,000 in sales, and the date nexus began. That start date matters because it determines how far back your obligation goes. If you have both physical and economic nexus, the rule is simple: whichever nexus type or connection came first controls the date. So if you had an employee in a state in 2015 but didn't cross the state's sales threshold until 2022, your responsibility to collect began in 2015. If the reverse is true, where you crossed the economic threshold first and added an employee later, then the start date is the year the economic threshold was first met. This timeline gives you a defensible record of when each obligation began and helps you register in the right order without over-registering for a missing state entirely. With all of this said, let's walk through an example to make this concrete. Imagine you run a small e-commerce business that sells home decor online. You're based in North Carolina, where you operate out of a small warehouse and office. That setup alone gives you physical nexus in North Carolina, so you're required to register and collect sales tax there from day one. In your first year, nearly all of your sales are to customers in North Carolina, and maybe a few to nearby states. At that point, your only nexus is physical, and it's limited to your home state. But as your business grows and your online orders increase, sales begin to spread across the region. After a couple of years, you notice that sales to customers in Florida have surpassed $100,000 in a calendar year. That means you've established economic nexus in Florida, even though you don't have a location, employee, or warehouse there. Now your nexus footprint includes North Carolina, which qualifies for physical Nexus because of the warehouse and office, and Florida, which qualifies for economic Nexus because your sales exceeded the $100,000 threshold. As time goes on, your footprint may expand into additional states. Not necessarily in a straight line across the country, but more depending on how and where your business grows. You might hire remote employees in one state, store inventory in another, or surpass economic thresholds in others. In other words, your Nexus footprint evolves as your business evolves, and it often develops unevenly across different states. Once you know where you've established Nexus, the next step is to register with the state and begin collecting. Some states like Florida expect you to start collecting as soon as you cross the threshold. Others like Michigan allow you to wait until January 1 of the following year. That's why it's important to note the date each threshold was crossed. Knowing the timeline helps you register in the right order and avoid missing a state or registering too soon. But you may be asking, what is your actual historical tax liability? Well, for more information on that, check out this video. And if you'd like help confirming where you have Nexus or creating a clean state-by-state footprint for your business, that's exactly what we do at Hands Off Sales Tax.